If you have a pension, there is roughly an 80% chance your investment portfolio is solving a problem your pension already solved for you, and the cost of that redundancy is not a rounding error. It is somewhere between $200,000 and $400,000 in foregone compounding over a 20-year retirement, invisible on every statement you will ever receive, actively happening right now to people who are otherwise careful, attentive, and would be genuinely appalled if you name the number. The system that caused it was not designed for them. It was built for the 68% of private sector workers who have no guaranteed income at all, and then handed, unchanged, to the tens of millions of people who do. Here is exactly what I'm going to show you today. A pension changes 3 specific things about retirement planning: your optimal investment allocation, your tax strategy and distribution, and your actual exposure to the one risk that destroys most retirement portfolios. I am going to walk through the math on each one. I am also going to show you a decision that exists inside almost every defined benefit plan, one most people make in a 30-minute administrative meeting with a worksheet designed for the average case, not their case, and give you the analysis that meeting never provides. And by the end, I want you to understand why guaranteed income is simultaneously the most powerful retirement asset most people will ever carry, and why, depending on what comes next, it can quietly become the most expensive one. By the way, I built a free early retirement calculator because most of the ones you find online produce mathematically incorrect results for anyone carrying guaranteed income. It uses BlackRock and Vanguard actuarial logic to find the weak points in your specific plan, and I only need your email to send the report. I do not store your financial data. Link is in the description. Before the mistakes, I need to give you the one mental model that holds this entire video together. Because once you have it, everything else follows in a way no brochure or advisor checklist ever quite manages. A pension is a floor, not a roof, not walls, not a foundation for some future ambition. A floor ground you cannot fall through. It arrives every single month, whether the market is down 40%, whether inflation is running hot, whether your brother-in-law's latest investment thesis turns out to be a Substack post. In many public plans, it rises with inflation, automatically every year. Whether or not the equity markets cooperate, the mistake, the one I see replicated across the financial histories of tens of millions of pension holders across every income bracket and every job category, is that people with a floor spend their careers building another floor on top of it. They accumulate bonds, CDs, conservative balance funds, target date glide paths, calibrated for someone standing on bare ground. They spend 30 years constructing a second floor, a third, a fourth, and they stand there surrounded by concrete, wondering why the view never changed. The floor is not your ceiling. That line runs through this video. Write it somewhere. I will come back to it every time we land somewhere important. About 15% of private sector workers still had access to a defined benefit pension plan as of 2024, according to the Bureau of Labor Statistics. In the public sector, teachers, firefighters, municipal employees, military, federal workers, that figure is closer to 86%. Tens of millions of Americans carrying this asset, managing their investment portfolios as if the asset does not exist, as if the floor was never poured. That is not a small calibration error. It is a structural one, and it compounds silently for decades. In a few minutes, I am going to show you a specific tax trap that hits pension holders during the distribution phase 1 that most financial advisors never flag, because flagging it requires treating your pension and your 401k as one integrated tax system, rather than 2 separate accounts that can each carry an annual management fee. But first, the allocation mistake, because it is the most widespread, the most invisible, and the entry point for understanding everything else. The conventional wisdom printed in retirement planning guides, embedded in target date fund glide paths, repeated in advisor meetings, without anyone questioning. The underlying premise says your portfolio should get more conservative as you age. The classic heuristic, your age in bonds. You are 60, hold 60% bonds. You are 63, hold 63% bonds. The rationale? Bonds are your stable, non-volatile income ballast. They protect you from market swings at an age when you cannot afford to wait out a recovery. The portfolio needs to generate reliable income in bad years as well as good, so it cannot afford to get hammered in year one of retirement. For someone with no guaranteed income, no pension, no annuity, nothing, that logic is internally consistent. The portfolio is the only paycheck in the room. It needs stability baked in. Bonds serve a real protective function for someone who must sell assets to cover expenses regardless of what markets are doing that month. Here is the thing nobody says in the brochure. Your pension is already doing what bonds are supposed to do. Think about what a bond fund actually provides. Predictable, regular income payments that are not tied to equity market performance. Now think about what a pension provides. Predictable, regular income payments that are not tied to equity market performance. Functionally identical roles in a retirement income architecture. The difference is that your pension carries no annual management fee, is often inflation adjusted in public plans, has legal protections, and carries a degree of governmental backing that most corporate bond issuers could not replicate if they tried. Your pension is, in analytical terms, a high-quality bond position you have been accumulating for 30 years. So when a pension holder also loads 60% of their investment portfolio into actual bond funds, they are buying flood insurance on a house that sits 200 feet above the floodplain. It feels responsible. It reads as responsible. It is expensive redundancy, and nothing on the statement ever calls it that. Let me put real numbers on this. Say you retire at 63. Your pension pays $3,200 a month, $38,400 per year. Social Security, which you are deferring until 67, will eventually add $2,300 a month. Your projected monthly expenses run about $5,500, $66,000 annually. Your pension alone covers 58% of that before you have touched a single investment dollar. The monthly gap between the pension and expenses is $2,300. When Social Security arrives at 67, you are actually running a surplus on guaranteed income alone without drawing a single dollar from investments. Now you have a $250,000 investment portfolio. A conventional advisor recommends $150,000 into bonds and conservative balanced funds because you are 63 and the glide path says so. What does that recommendation actually cost you? The long-run difference between a 4% annualized return, what a bond-heavy balanced fund might realistically deliver, and an 8% annualized return on $150,000, compounded over 20 years, is approximately $411,000. You did not lose that to fraud. The market did not take it. You lost $411,000 by being conservative with capital that was not doing survival work because the pension was already doing that work. The portfolio was surplus capital. Surplus capital, treated as survival capital, does exactly what you would expect, survives instead of grows. There is a concept in institutional portfolio management called asset liability matching. The idea is that you structure your investment assets to correspond to your actual financial liabilities, ongoing expenses, fixed obligations. If those liabilities are largely covered by guaranteed income, the investment assets are freed up to pursue growth. The pension handled the liability matching. The portfolio's mandate changed the day the pension was earned. Nobody sent a memo. I want to tell you a short story. There's a version of this that appears across various finance writing, but the specific application here changes it. A farmer owned a stretch of extraordinarily productive land. Every harvest, instead of putting the profits to work elsewhere, he spent everything he made buying more land. His neighbors could not make sense of it. One of them finally asked him one afternoon over a fence post. The farmer said, "Because I might lose this land someday. I need more land as a backup." His neighbor looked at him, then looked at the land, then said, "Your plan for losing productive land is to acquire more land that is also not producing?" That is, the pension holder who loads up on bonds as insurance against the day the pension stops arriving. The hedge against losing the floor is more floor, and the cost is $411,000 per $250,000 invested over 20 years, with nothing on the statement to name it as a loss. Now, some of you are thinking about underfunded plans right now. That concern is not irrational. Pew Charitable Trusts estimated a collective underfunding gap of approximately $1.2 trillion across state pension systems as of 2023. That number sounds like an extinction event in a headline. But complete immediate elimination of earned benefits is a legally and politically extraordinary event. Detroit's 2013 bankruptcy resulted in benefit reductions, not elimination. Retirees still received payments. Partial cuts, phase-ins, modifications applied to new hires rather than current retirees, these happen. Zero does not happen in the base case. A 20% haircut in a genuine stress scenario is worth structuring around if you are in a visibly underfunded plan. That is not the same as managing a $250,000 portfolio as if the pension contributes nothing to your monthly income. This is where it gets really interesting. The allocation mistake is only the visible surface. Underneath it is a tax problem that is structurally worse, more permanent, and almost never discussed in pension-specific terms. And by the time most people encounter it, the decisions that caused it are irreversible. You spent your working years contributing to a traditional 401k, took the deduction every year, lowered your taxable income. That was correct at the time. The logic, defer taxes now, pay them later in retirement when your income will be lower and your marginal rate will follow. Standard advice. Usually right. Here is what almost nobody modeled if you have a pension. Your retirement income floor is already substantial before you withdraw a single dollar from the 401k, $38,400 per year from the pension alone. Once Social Security eventually adds another $27,600, you are at $66,000 in taxable income before touching the investment account at all. In 2026, the 22% federal bracket for a single filer begins around $47,000. A married couple filing jointly hits 22% at roughly $94,000. Depending on filing status, many pension holders are already sitting firmly in the 22 or 24% bracket from pension and Social Security alone, before required minimum distributions have even begun. At age 73, the IRS requires you to start taking required minimum distributions. On a 401k that grew to $400,000, the first year RMD is roughly $15,000. Stack that on top of $66,000. You are at $81,000 in taxable income. For many pension holders, that is a permanent address in the 24% bracket for the remainder of retirement. You think the 401k is a tax tool. For 30 years of accumulation, it was. But for a pension holder in distribution, the pension fills the lower brackets before the 401k money arrives, which means every traditional withdrawal is taxed at a higher effective rate than it would be for a retiree without guaranteed income. The tax-deferred strategy worked exactly as designed on the way in. On the way out, with a pension occupying your bracket space from below, it can produce the precise opposite of the intended result. By the way, if you are finding this useful, hit subscribe. YouTube's algorithm may genuinely never show you this channel again if you do not, and I put this level of research into every video. The practical implication is direct. If you are still working and your employer offers a Roth 401k alongside the traditional option, you should be directing significantly more toward the Roth than any pension agnostic advisor would suggest. Pay the tax now at your current marginal rate on money that will grow tax-free and withdraw tax-free in retirement without creating additional taxable income layered on top of your pension and without triggering required minimum distributions at 73. The other move, and this is where meaningful money actually gets captured, is Roth conversions during the gap years. If you retire at 63 and defer Social Security until 67, you have a 4-year window where your taxable income is your pension and nothing else. $38,400 per year. In that window, depending on your deductions and filing status, your marginal federal rate on additional income may sit at 12%. Convert $20,000 per year of your traditional 401k into a Roth IRA during each of those 4 years. Pay 12% now on money that would otherwise be taxed at 22 or 24% when forced RMDs hit at 73. On $80,000 converted over 4 years, the tax differential is roughly $8,000 of additional tax paid up front. That sounds like a cost. Over 25 years of retirement, that deliberate bracket filling strategy during a pension-created income gap is worth north of $80,000 in after-tax wealth. Not from market timing, from a calendar and a working knowledge of where you sit in the tax brackets. Now I want to introduce you to Marcus, because Marcus is the reason all of this stops being abstract. Marcus spent 28 years as a public school administrator in Ohio, retired at 61 with a state pension, paying $41,000 a year, inflation adjusted at 2% annually. He also had a 401k with $320,000 in it, sitting almost entirely in a target date 2025 fund, roughly 45% bonds and 55% equities at his age. And he had $60,000 in a money market account he had been calling his emergency fund for 11 years, had not touched it once. Marcus thought he had done everything right. Pension, check. 401k, check. Emergency fund, check. By every standard checklist, Marcus was a model of financial responsibility. The problem was that his situation was not a standard checklist situation. His pension covered 75% of his projected retirement expenses before any portfolio withdrawals. His Social Security, which he was planning to claim at 62, the earliest eligible age, would add approximately $16,000 a year. But Social Security claimed at 62 is permanently reduced by roughly 30% compared to full retirement age. Over a 25-year retirement, that permanent reduction on his specific benefit translated to a lifetime shortfall of approximately $87,000 in cumulative Social Security income. Not a one-time penalty, a permanent monthly trim applied every month for the rest of his life, multiplied by however long he lived. Marcus had not modeled it because nobody had asked him the question. His portfolio was 45% bonds on capital he did not actually need bond-like income from, because the pension was already generating stable, non-market correlated income every single month. His $60,000 emergency fund, earning 4.5% against inflation, running around 2.8% in early 2026, was generating real returns of maybe 1.7% per year on $60,000 for 11 years. On money that had not moved. Marcus was not making bad decisions in isolation. He was making appropriate decisions inside an inappropriate framework. He had a floor. He was building more floor. Nobody had handed him a blueprint for what to build once the floor was already poured. Here's something worth sitting with before we go any further. The gap between understanding these mechanics and having a system that actually executes them is wider than it looks. Knowing your coverage ratio matters is not the same as having a methodology that models your bracket filling windows, your sequence of returns exposure adjusted for guaranteed income, and your lump sum break even under realistic return assumptions. I spent about a year compiling 50 years of actual retirement data into a framework I called the Exit Code. It is a digital book, 8 chapters built on historical data, not on the conventional narrative your financial advisor inherited from a product training program. 2 things in it connect directly to what I just covered. The first is what I call the 58% rule, the specific guaranteed income coverage threshold below which your portfolio genuinely needs conservative treatment and above which your allocation strategy should look fundamentally different. Most pension holders who run this calculation discover they are well above 58% while managing their portfolios as if they are below it. The compounding cost of that gap over 20 years is not cosmetic. The second is what I call the dynamic withdrawal method, which replaces the static 4% rule with an approach calibrated to the reality that a pension holder does not need to draw from the portfolio every year, only in the years guaranteed income falls short of expenses. Over a 25-year retirement modeled against historical return sequences, the difference between static and dynamic withdrawal translates to a meaningful increase in lifetime distributions without increasing depletion risk. The reason most people who try to plan early retirement quit the modeling by month 3 is that nobody showed them what a bad sequence of returns actually looks like on a spreadsheet alongside a guaranteed income floor. That is what the book does. You can get it through the link in the description for less than you would spend on a decent dinner out. Stay with me, because this next part involves a decision most pension holders do not realize they're actively making, and by the time they realize it, The window to make it differently has already closed. Most defined benefit pension plans offer you a choice at retirement. Take the annuity, the monthly income stream for life, potentially with a survivor benefit for a spouse. Or take the lump sum, a single large cash payment you manage yourself from that point forward. This is one of the most consequential, irreversible financial decisions most people will ever face. It is frequently made in a single 30-minute meeting with a plan administrator who works for the pension fund using a worksheet that in many cases has not been substantively updated since the 90s and who is not legally required to act in your financial interest. Just initial here and here, the brochure explains the rest. Reader, the brochure does not explain the rest. Here is the concrete math on a lump sum versus annuity comparison. Your pension offers a lump sum of $350,000 or a lifetime annuity of $2,100 a month, $25,200 per year. You are 62 and in reasonable health. Invest a lump sum at 7% average annual return conservative relative to the historical long-run nominal return of a diversified equity portfolio going back to 1926. Withdraw at 4% annually, and you draw $14,000 per year while the principal continues growing with no withdrawals at all. 7% on $350,000 over 25 years becomes approximately $1.9 million. The annuity over 30 years of payments totals $630,000 with no residual balance. The break-even, the age at which cumulative annuity payments exceed the invested lump sum's total value, depends entirely on the assumed return. At 4%, the annuity often wins around age 78 or 79. At 7%, the lump sum may never be surpassed in total value because the principal keeps compounding past the annuity's flat monthly payment indefinitely. The annuity's structural advantage is longevity insurance, pure protection against living to 95 or 100. The lump sum's advantage is growth, flexibility, estate transfer, and the ability to adapt as circumstances evolve. The administrator's worksheet implicitly frames the annuity as the responsible default and the lump sum as the option for people who think they are smarter than average but often are not. That framing serves the pension fund's actuarial model more than it serves you. Nobody is lying. The worksheet is probably correct for the median person making the decision. It is not calibrated for someone who already has a floor and is thinking about how to build on top of it. There's also a detail about survivor benefit tiers that the meeting will briefly mention and then move past. A 100% joint and survivor annuity, meaning your spouse receives the full monthly benefit if you predecease them, is typically $150 to $250 a month lower than a single life annuity. Over 30 years, that monthly gap represents $54,000 to $90,000 in total payment difference. Whether that is worth paying for the survivor coverage depends entirely on your spouse's health, age, other income sources, and the size of your combined estate. The worksheet will explain that the tiers exist. It will not help you decide which one fits your specific situation. Your advisor's internal monologue at that meeting probably. They have a pension, they have savings, they seem anxious about markets, balanced fund, conservative glide path. They feel stable, I keep the fee, and the brochure does the rest. Two of those people won. More floor, said the floor to itself, about itself. Now, here is the final piece, the one that connects the allocation mistake, the tax trap, and the lump sum decision into a single unified picture. And it reveals a structural advantage that pension holders are sitting on without knowing it and systematically dismantling in bond funds without being told. Sequence of returns risk. Even if your portfolio averages 7% annually over 30 years, if the major market crashes happen in the first 3 to 5 years of retirement, when you are forced to sell assets at depressed prices to cover monthly expenses, you lock in losses at exactly the wrong moment. The compounding never fully recovers. A portfolio that drops 40% in year one and grows 12% for 29 years generates dramatically less lifetime wealth than one that grows 12% for 29 years and drops 40% in year 30. The sequence of returns, not the average return, determines outcomes. William Bengen's 4% rule, published in 1994, was calibrated to survive the absolute worst historical sequences, the 1970s stagflation environment, the early 1930s collapse scenarios. The rule assumes the portfolio must fund all expenses, even in brutal market conditions, which means mandatory selling in down markets to pay rent. That is the specific scenario the 4% rule was designed to survive. The 4% rule was not designed for you. If your pension and Social Security together cover 60% or more of your monthly expenses, you do not sell in the crash. The pension check arrives regardless of what the S&P 500 did this quarter. You hold, you wait, you let positions recover without the pressure of impending bills. In a severely distressed market, you might deploy surplus pension income into equities at distressed prices, turning someone else's panic into a long position. That option is literally unavailable to a retiree without guaranteed income, who is selling assets to pay next month's expenses no matter what. Dalbar's annual quantitative analysis of investor behavior has consistently found that the average equity fund investor underperforms the S&P 500 by between 1.5 and 3% annually due to panic-driven, mistimed exits. On a $250,000 portfolio, 3% of annual behavioral drag over 20 years costs approximately $240,000, not from fees, from flinching at the bottom of a cycle. The pension eliminates the flinch. It decouples your financial survival from market timing. Stanford Center on Longevity published research in 2019 finding that a guaranteed income floor is the single strongest predictor of retirement portfolio sustainability, more predictive than total nest egg size. People with a consumption floor held equities longer through market cycles, avoided panic-driven selling, and died with substantially more wealth than those without a floor who had been forced into conservative allocations to manage the anxiety of having no guaranteed baseline income. The floor does not constrain wealth building. It amplifies your ability to build it if you use it correctly. And here's the thing I keep coming back to, the one that sits with me after all the financial histories I have worked through. The retirees most structurally protected against sequence of returns risk pension holders, by definition, because the pension funds, the expenses that would otherwise force selling in a down market, are statistically the most focused on conservative investing as additional protection against sequence of returns risk. They solve the problem. Then they refused to believe the problem was solved. Then they paid in bond funds and conservative target date glide paths to solve it again. For 20 years. While the surplus capital sat generating below its potential, and nobody on the statement ever named the redundancy as a cost. That is not a financial planning failure. That is a psychological one. The floor creates an overwhelming feeling of security. The brain then does everything in its power to protect that feeling, even at a cost of several $100,000 in foregone compounding across 2 decades of retirement. The loss is invisible on the statement. It shows up only in retrospect, by which point every decision that caused it has long since stopped being reversible. Now, here is the framework that turns all of this into a decision system. 3 levels, because where you are in your career determines what actions are actually available to you right now. Level 1, you are still working more than 10 years from retirement. The pension is a future number. You are accumulating. The primary action at this level is tax positioning. If your employer offers a Roth 401k alongside the traditional option, direct significantly more toward the Roth than any pension agnostic plan would suggest. The pension will fill your lower tax brackets in retirement and compress the advantage of traditional deferral. Pay the tax now on money that will grow tax-free and withdraw tax-free without creating additional taxable income layered on top of the pension in distribution, and without RMD pressure at 73. Also at level 1, understand your pension plan's benefit formula and whether a lump sum option exists. Plan administrators do not advertise the lump sum. Ask explicitly. Give yourself a decade to analyze a decision that most people handle in 30 minutes while signing paperwork they barely read. Level 2. Within 10 years of retirement, the allocation question becomes active. Model your projected guaranteed income at your target retirement date, pension at your intended start date, Social Security at your planned claiming age, any other guaranteed income streams, subtract from projected annual expenses. The difference is the gap. That is the actual amount your portfolio needs to generate. Divide the portfolio conceptually into two pools. Pool 1 covers the gap it might hold some stable, income-generating assets to smooth coverage in lean years. Pool 2 is everything beyond gap coverage. Pool 2 is surplus capital and should be invested more aggressively than any target date fund calibrated to your age would ever recommend. Because Pool 2 is not doing survival work. It can absorb volatility. It can be patient through a full bear market cycle. It has the luxury of waiting because Pool 1 and your guaranteed income are handling the baseline expenses every single month. Level 3, at or near retirement. The annuity versus lump sum decision is real and imminent. Model both scenarios with your actual numbers. Use a 7% return assumption, not 10, which is optimistic, and not 4, which understates long-run equity performance in a diversified portfolio. Account for the tax treatment of the lump sum in the year of distribution. A large lump sum hitting your taxable income in a single calendar year can create a bracket spike that substantially erodes the apparent advantage over the annuity. Look at IRA rollover strategies to manage the timing across tax years. Factor in your health trajectory, your spouse's survivor income situation, and your estate intentions. Hire a fee-only fiduciary planner for a flat fee engagement to build the model with you, not a product-compensated advisor, not the plan administrator, a fiduciary. Someone who charges a flat fee or hourly rate and earns nothing from what you ultimately decide. The annuity is probably right for most people who walk into that 30-minute meeting. Probably right for most people and definitively right for you after running the numbers are two completely different conclusions, and only one of them requires doing the actual math. Marcus, the Ohio school administrator, sent a brief update through a mutual contact about 12 months after his financial picture was fully modeled. He had repositioned Pool 2 into a higher equity allocation. He had closed most of his $60,000 money market position, which had been serving as an emergency fund for a retiree with a guaranteed monthly pension check, which is roughly equivalent to buying a backup generator for a house that is already hardwired to a nuclear plant and redeployed the capital into the portfolio. He had begun Roth conversions during his pre-Social Security gap years at the 12% bracket, and he had engaged a fee-only fiduciary to model the lump sum equivalent in his plan and run the break-even analysis with a 7% return assumption rather than whatever the worksheet assumed. Marcus was not dramatically wealthier 12 months later. Compounding does not move at that speed, but he had exited the framework that was making him feel responsible while quietly costing him money. That is the step. The one most pension holders never take because the framework they are inside looks from the inside exactly like financial prudence. His two colleagues from the Ohio state system, both of whom took the annuity without running a lump sum analysis, both sitting near 50% bonds in their 401k, were sleeping fine. Their statements looked clean. Their advisors nodded approvingly. 10 years from now, the gap between their portfolios and what the numbers could have produced will be invisible on the surface and significant in the arithmetic. The floor is not your ceiling. But if you never look up, you will never know the difference. 3 specific things to do differently. Not generic retirement advice, calibrated to this exact situation. First, calculate your guaranteed income coverage ratio before making a single allocation decision. Annualize all guaranteed income pension, Social Security at your plan claiming age, any other guaranteed monthly sources. Divide by projected annual expenses. If that ratio is above 60%, your bond allocation is almost certainly too high. Not slightly, materially. Every dollar of unnecessary bonds is a dollar of surplus capital parked where it cannot compound at its potential. This takes 20 minutes. It changes the entire investment framework. Second, if you are still accumulating, shift toward Roth contributions more aggressively than any pension agnostic advisor would recommend, and plan explicitly for Roth conversions during the gap years between your retirement date and Social Security. The 12% bracket during that specific window is one of the most underused tax advantages available to pension holders, and it requires nothing beyond timing and awareness of where you sit in the brackets. Third, If your plan offers a lump sum option and you are within 5 years of the decision, treat it as the major irreversible financial event it actually is. Model both scenarios with honest return assumptions. Hire a fee-only fiduciary. Consider your health, your spouse's survivor income needs, your estate goals, and the tax treatment in the distribution year. The annuity is probably the right answer for most people who make this decision without running the numbers. Probably right for most people is not the same as the correct conclusion for you, specifically after the analysis has been done. Lazy investing built more fortune than crypto memes. And the pension you spent 30 years earning is the most structurally powerful advantage in your retirement plan. The question is whether you treat it like the floor it is or spend the rest of your life pouring concrete on top of it.